These documents could not be any more different, and the implications of using the wrong document are huge. In this video, we will discuss the difference between a share subscription agreement and a share purchase agreement. Make sure to stay until the end of the video to find out the stamp duty tax difference. If you're new, I'm Zoppi, an English qualified solicitor, and I help UK SMEs with their corporate and commercial legal needs. In this video, we'll focus on three main differences. Firstly, new versus old shares. So the subscription agreement allows the subscriber to subscribe or buy into new shares that are issued or created by the company. Typically, the subscription agreement is used by companies to get their investors to sign and agree to invest money in return for shares. On the other hand, the share purchase agreement typically is made privately between individuals or entities and is for the purchase of shares that already exist, that have already been owned by another person. And the goal is to buy the entire company, and the way in which this is done is by buying the shares of that company. So in a subscription agreement, it's the investor who ends up with a percentage, a few shares in return for money that they gave to the company. And in a share purchase agreement, the buyer ends up with the entire company through the purchase of shares. The second main difference is the length of the document. With a subscription agreement, typically it's no more than 15 pages long, quite a short document. With a share purchase agreement, it's not uncommon to find SPAs that are at least 100 pages long. And that is largely due to the contents of the document, which brings us to our third main difference. In a subscription agreement, typically it is the company that tells the investor what kind of shares that they're giving, and there are more information about the investment rounds. Instead, when it comes to the share purchase agreement, a large section of the document is taken up by warranties that are given by the seller or sellers of the shares to the buyer. And the warranties are promises that the sellers are making as to the state of the business that the buyer is buying under the share purchase agreement. Now, before we discuss the stamp duty tax difference, feel free to send me an email if looking for professional legal advice. Great, so how are the two documents treated differently from a stamp duty perspective? Well, it's a relationship that is recognized as different by HMRC. So stamp duty is payable in a share purchase agreement typically if the purchase price is above £1,000. That is because there is a buyer and a seller of shares, and stamp duty is payable on that purchase of shares. Stamp duty is payable by the buyer, but there could be capital gains tax to be paid by the seller on the sale of those shares. Instead, when it comes to the subscription of shares, so that is when the company is issuing new shares to an investor or a shareholder, then typically there is no stamp duty payable or any capital gains payable. If you want to learn more about share purchase agreement, especially if you're looking to buy a business, make sure to watch this video right here.